Okay, so this is a continuation of our basic ideas of credit cards. These are the examples from section 4, which we were not able to finish on Tuesday. Frank lost his credit card in a local mall. He notified his creditor before the card was used. However, later that day, someone found the card and charged $700 worth of hockey equipment on it. How much is Frank responsible for paying? Well, the rule is up to $50 of charges before report. Since Frank notified them before the card was used, he will not have to pay any money. He'll pay $0. Our next example, credit card companies issue a monthly statement, and therefore the APR must be converted to a monthly percentage rate. So we have our annual percentage rate. So remember, APR is annual percentage rate. So to find the monthly, we take the annual and we divide it by 12. So our monthly is going to be 21.6% divided by 12, which is going to give us a monthly percentage rate of 1.8% per month. Okay, next we need to talk about the average daily balance. Now, as you use a credit card from day to day, your balance fluctuates. And this is due to charges or credits versus payments or returns or things like that. The average daily balance is calculated by taking the number of days times a certain balance plus a number of days times the next balance, etc. And then dividing by the total number of days in the billing cycle. And this is used to calculate finance charge. Okay, so we'll talk about how to calculate that, but know that your average daily balance is the balance used to calculate the finance charges, and it's multiplied towards that 1.8% per month. This is the MPR for the monthly periodic rate. Okay, so Rebecca didn't pay last month's credit card bill in full. So here are her daily balances for the last billing cycle. So she had 7 days where her balance was $456.11. Then 3 days it was $1,177.60. Then 6 days $990.08. 9 days $215.15. $21.15.15. And then for 5 days it was $22.09. So the first thing we need to do is find the total days. So we'll add 7 plus 3, which is 10. 16, 25, 30. So 30 total days. The next thing we do is we take 7 days times 456.11. Then she had 3 days at $1177.60. And then 6 days at $990.08. And then 9 days at $21.15.15, and then 5 days at $22.09.13. So we're going to multiply that. 7 times 456.11 is 319277. 3 times 11, 7760. Is 353280. 6 times 99008 is 594048. 9 times 211515 is 193635. And 5 times 220913 is 114565. Now we'll add all those together. And we get 42,748.05. Now this is not the average daily balance yet. So we take the sum and we divide it by the number of days. So 42,748.05 divided by 30. So this gives her an average daily balance of 1424.94. This is used to calculate her finance charge. Now you want to make sure you divide it by the number of days, because if you calculated the finance charge on the 42,000, it would be way too high. Okay, so did I make a mistake? Okay, I somehow wrote this number down wrong. Okay, so her average daily balance is 1424.94, and she pays a finance charge on that. Her APR is 18%. So first we find the monthly periodic rate. So we take that 18% and we divide it by 12. That's 1.5%. And then we convert that to a decimal by moving 2 places to the left. So that's 0.015. Next, you multiply the average daily balance times the monthly periodic rate as a decimal. So I take 1424.94 times 0.015. And her finance charges for the month are $21.37. So that's how much she's going to pay in interest for that month. Okay, for section 5, we're talking about credit card statements. This is the bill that you receive in the mail. So we have some vocabulary for this as well. The billing cycle is a preset amount of time set by the company used to calculate the bill. Okay, this time can vary from 21 to 31 days. Typically, is a 30-day cycle, is the most common. Some companies do a calendar month, so your cycle will vary between 28, 30, and 31 days. And some, if you have poor credit, will do a shorter billing cycle, like 21 days. The credit card statement is the bill that you receive in the mail. Or electronically, if you have like paperless billing. And it is an accounting of all the activity on your card. So this is charges, credits, interest. They tell you your minimum payment, balance, etc. And the following things will all appear on the credit card statement. So everything from here down. Your account number, which is a unique number that identifies your account. Okay, your credit line, which is the maximum you can charge at any time. Your available credit, which is the difference between what you owe, which is your current balance, and your credit line. Next, we have the billing date, which is the date that the statement was processed. Which is the last day of the billing cycle. What they'll do is, say for example, the billing cycle ends on the 5th. So at the close of business that day, which is usually about 5 p.m., they start processing the statements. And so you get that date. So anything that happens before 5 p.m. will show up on this date, on this billing cycle, and anything after 5 p.m. or whatever time they set would show up on the following date. Your payment due date is the day that the payment must be received. By the creditor, so the credit card company. Any other day after that, and you're going to incur a late fee. Transactions, it lists the purchases and the dates. The date can be the day posted, or it could be the actual date. So if you go to the store and you buy something with your credit card on like the 3rd, on your statement it may show as the 3rd, or it may show as like the 5th or 6th, which would be the date that the company processed it. That depends on the actual company itself. Some list both. For most, it's not itemized. So for example, if you go shopping at Publix, you're not going to get your grocery list of what you bought. You're going to get the store and the amount. Then you have debits and credits. Debits are money charged to your account. Adds to what you owe. That's a debit, sorry. Okay, credits are money paid to your account. So payments, refunds, things like that, that subtract from the amount you owe. You get your previous balance, which is the money owed from before current billing period. Got the word before. So this is any money not paid off, and that's carried over. And it's carried over to the new billing cycle. Next, you have payments and credits. This is the same thing as the credits and debits. This is payments or other credits. This is the total, and it's deducted from your balance. Which is the money owed. Then you have new purchases, which is the total of all the debits. So this is added to the balance, which is money owed. There's a section that shows your late charges. This is a penalty for payments paid after the due date. And they get added to your balance. Okay, and now the thing about a late charge is if you get a late charge on your bill and then you don't pay enough of the bill to take out the late charge, so you make a minimum payment and you don't pay extra for the late charge, you then start paying interest on the late charges. So you really want to be careful not to accrue any of those late charges. Your finance charge is the cost of using the credit card. This is the interest that you're paying. And it's not really a loan, but it's kind of a loan. They're loaning you the money to buy the things. You're just paying them back on a credit card instead of an official like bank loan. But it's the interest that you're paying on the loan, and that's for the current billing period. Now, your finance charges will get paid off if you pay your minimum payment, because they always take the interest first and then apply whatever is left to the principal. So when we looked at our last example, and she had a finance charge of 21 something, if your minimum payment is 25 and you only pay 25, 21 goes to pay the finance charge, and then 4 goes to pay towards knocking money off your balance. So you always want to be aware of how much the finance charge is versus how much your minimum payment is, so you know how much you're paying off on your balance. Your new balance is the amount you currently owe. And this is calculated by taking the previous balance. They subtract any payments or credits. They add new purchases. They add a late charge if there is one. They add the finance charge. And that gives you your new balance. Okay, your minimum payment is the lowest payment you can make to remain in good standing. If you can't afford your minimum payment, it's better to pay something than nothing at all. So if your minimum payment, for example, was $25 and you can only afford to pay 10 at the time, pay the 10. You're still going to get a late charge, and it doesn't do much. It's not really good for you to do that, but it's better to pay something than nothing. Okay, your average daily balance, we calculated that. This is the average amount owed per day. Of the billing cycle. And then the number of days in the billing cycle is the total number of days that are showing up on the statement. You have your APR, which is your annual percentage rate. And then you have your monthly periodic rate, which is MPR, which is your monthly percentage that you're charged, which is the APR divided by 12. Okay, all of these will show up on a credit card statement. We have an example of a sample statement here. You've got your account number, the billing date, when the payment's due. You have your transactions. These are all your debits and credits. So you have a list of the date and the transaction, and then if it's a debit, it's positive because it's being added to your balance. So it's positive. And then credits are subtracted. So they're negative. You have your previous balance, your payment, which was $75. You have your new purchases. So all of these together make up new purchases. There was no late charge because apparently Jane paid on time. Good for her. You have your finance charge, which was from taking the monthly periodic rate times the average daily balance. And then you have your new balance. And again, this was calculated by taking the previous balance, subtracting the payments and credits, adding the new purchases, adding a late charge, adding the finance charge, and that gives you your new balance. The minimum payment, average daily balance, number of days in billing cycle, annual percentage rate, monthly periodic rate. You have your total credit line. This is your max. And then you have your available credit. This is what you can still spend. Okay. So let's look at the summary portion. And for the first question, A, we're going to explain how the new purchases amount was determined. So we have new purchases, and they were added together. So we had 75 plus 3185. $139.10 and $38.50. And I'm not actually writing down an explanation, but 75 plus 3185 plus 139.10 plus 38.50 gives us 284.50. 284.45. I must have entered something in the calculator wrong. Okay, so it was calculated by adding all debits. Okay, the new balance amount was determined by taking the previous balance, which was $150.50. We subtracted the payment. We add the new purchases. We add the late charge, but there wasn't one. And then we add the finance charge. We got 363.48, 363.48. So we've got previous balance minus the payment plus new purchases plus late fee, if there is one, plus the finance charge. So that's how that was calculated. Okay, so Pasquale has a credit line of $15,000 on his credit card. I think that was meant to be $1,500. Well, we'll say $15,000. His summary looks as followed. And how much available credit does he have? Well, we're going to subtract, add, and enter. And we want to always double check this. This is a double check, because you want to make sure that they've been calculated correctly. Okay, we've got 363.48, so this is the same as we just did. So it checks out. We take the credit line and you subtract the new balance to get your available balance. So I have that 15,000 minus the 363.48 and his credit limit would be $14,636.52. Okay, we have Myrna, who's examining the summary section of her credit card statement, and she checked all the entries of her bill and she agrees with everything except the new balance. We want to see if there was an error. So if I subtract here, add, and add, what will it equal? So I've got 1748 minus 100 plus 800 plus 915 plus $19. And I get 2476.15. Well, they say it's 2576.15. if we subtract that, we're going to get a difference of $100 exactly. When we look at this, she's a payment of $100. They did not credit her payment. So if we take out this minus 100, we would get 2576.15. So what happened is when they were doing the calculations, the payment did not get subtracted from her balance. Okay, we're going to stop there. And for homework, $40 through $63 odds. Remember that evens are extra points. We'll go over this on Monday. We'll finish the chapter. We'll review on Tuesday. And the test will be Wednesday.